And we are watching shares of Canadian Pacific Kansas City Rail this morning after the company reported a big boost in profit despite tariff challenges. And you can see it's pretty much a wash right now, up a cent. And while grain, potash, and container volumes rose since the same time last year, cross-border trade of steel is about 50% lower as the tariffs slow trade. Here to tell us more about this, Jeffrey Kauffman, a partner at Logistics, Transportation, and Equipment Research at Vertical Research Partners. Jeffrey, thanks very much for joining us.
Thank you. Good morning.
Is this a good year for CPKC?
I
good
think
report,
good results.
I should say.
Yeah, it's probably the best of the rail reports in terms of margin improvement. We saw about a 260 basis point improvement in margins. It's one of the few rails that actually improve margins. So I think that alone stands out. But there's a very difficult year for freight. I mean, you've got trade headwinds. It's made import-export volumes occur at times that you normally don't see them. And you just mentioned steel. Because of the steel and aluminum tariffs, there's a lot of companies trying to source locally. And then, are we moving our grain overseas? Are we not? So a lot of real challenges this year. And I think CP is really navigating those challenges well in a difficult environment.
Well, yeah, what is it, a 50% drop in cross-border for steel? Where did they make that up? How did they manage to make that up?
Well, you don't really make it up, but what you can do is you can take those cars and you can reallocate them to other areas. Now, I wouldn't take a steel car and put it in a grain field, but their auto traffic, for instance, was up. So there's areas where you can redeploy assets, or what a railroad's really good about sometimes is just putting an asset out of use on the side of the track and then reallocating the locomotives to a different part of the network.
And that saves the money by putting those on the side, but still have the locomotives working.
Yeah, and then you make money in other areas end of day. And then this is railroading 101. So we would see the same thing if the economy were weak, if the economy were strong, if for some reason a coal mine went out of service and they had to reallocate capacity elsewhere. So railroads are really good at bobbing and weaving when these types of things happen.
And how much bobbing and weaving are they going to have to do in the coming year? I guess it all depends on what happens with tariffs. It all depends on what happens with those deals, right?
Well, some of it does, but you can still move Canadian traffic through Vancouver to Southeast Asia, whereas it may be a little challenging, say, for soybean exports from U.S. ports if U.S. and China don't reach an agreement. But what I would focus on more with CP isn't so much that, but some new opportunities that they're going to have to generate traffic as they get. So, for instance, the Meridian Speedway part of the Kansas City Southern line between Dallas and Atlanta, basically, you've now raised the speed limit to 49 miles an hour on that rail from a number that was in the 20s and 30s. So you can drive more traffic across that area. They just announced new agreements, the BN and the CSX to move intermodal in the Southeast. I know CP's been talking with BN about partnering with CSX on new projects. So, there are new revenue opportunities. And aside from that, they are still making the Canadian rail property integrate with the Kansas City Southern property and then out of Mexico. And they're generating cost efficiencies and new train efficiencies and new volumes there. So separate from anything that's going on with trade and tariff and the economy, there's a lot of opportunity over the next 2 to 3 years for CP to really drive new revenue and drive operating efficiencies and therefore more earnings.
Okay, as a non-railway guy, I'm just curious, what kind of a difference does it make when they up the speed limit from, I think you said 25 to about 49 miles an hour? How much of a difference? How much more can you move through there at that point?
Well, I'm not going to say double, but maybe 30, 40, 50% more on the same space on a line. So effectively, you're moving traffic, you're moving it faster, and in theory, you're moving it with fewer assets if you can accommodate longer trains on that line.
All right. And potential Norfolk Southern Union Pacific merger, what's happening with that right now?
Well, I think investors really appreciate Keith Creel's perspective on that because he was more right than the Canadian National was in the Kansas City Southern acquisition. I think people feel that Keith really has his thumb on the pulse of kind of where the regulators are headed. And I think his view is This is not a done deal. There are some high hurdles that need to be crossed in terms of promoting new competition on a rail line. As Keith said, it's not just about the 10 or 15 customers that go from 2 to 1, but it's about the entire effects on the network. And he doesn't see a deal being done early, and he doesn't see a deal being done without what we would call concessions. And these concessions might, for instance, be things like, oh, well, we're going to invite Canadian Pacific in to bid on this traffic, or we'll invite Burlington Northern in because we want to create more competition. So I think Keith's view is the rail merger is not necessarily a certainty. The regulators may accept the application and then take 16, 17, 18 months to figure out what they want to do with it. And in his view, there might be some opportunity that comes to rails such as the CPKC or CSX if the regulator's looking to promote more open competition as a result of the merger.
Okay. Jeffrey, thank you very much for joining us.
Thank you.
Jeffrey Kauffman is the partner at Logistics, Transportation, and Equipment Research at Vertical Research Partners.